Welcome to This Week in Money. I'm Jim Goddard. Today, Ross Clark from Chartsandmarkets.com runs down the major markets. He tells us the fallout wasn't that bad following the collapse of two U.S. banks. He believes there could be some opportunities in high tech. Kaiser.Research.com's John Kaiser feels the time is ripe to believe in junior mining companies again with a focus on electric vehicles and battery materials. He also gives us his take on the recent PDAC get-together in Toronto. Inside Track Trading President Eric Hadik takes a gander at the cycles concerning interest rates, bonds, gold, energy, and weather. Eric weighs in on the possibility California will be in for another wet winter. We'll talk to Ross Clark right after this.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is Ross Clark from Chartsandmarkets.com, where you'll find insightful market commentary and timely technical analysis. You can find him on Twitter at ChartsByRoss. Welcome back to the show, Ross.
Good to be with you, Jim.
Well, a little bank in the Silicon Valley decided to go, as they say, eyes up towards the moon.
Yeah, that's it. There's one thing here about, having exposure on one end of the curve and then offsetting it with the wrong end of the curve and when it comes to money. And gosh almighty, I thought that's a lesson that had been learned many, many times over the years. But I guess when you don't have the right risk manager in place, things can get out of hand, and especially when you have a lot of money coming at you during the COVID period, people take advantage of it, and guess what? Things go sour slowly and then fall apart.
So a week out from the SVP and Signature Bank collapses, what kind of a fallout have we seen in the markets?
Well, I mean, it really is, depends upon what you're looking at here. The broad market, we look at like an S&P. The S&P here on the week is, now we've got a few hours left here in terms of just when we're doing this, but, the market as a whole has held up reasonably well. You got the S&P just a shade higher on the week. You've got the Dow, which has had a poorer week now marginally, but over with the NASDAQ, the money has been flowing around. You've got a pretty good week for NASDAQ, and as soon as you get away from the money center type of things, it was holding up reasonably well. You got, but on the items in the banking, take a look at the KRE, which is the regional banking index, including, some of these ones that have really been decimated. So we've got big oversold readings here, the type of thing that you only see like in 08 and in 02 and back in 1987. So when you look at that, the time it takes for these things to wash out, we generally get huge oversold readings such as we have now. And then you can take the better part of a few weeks to try and base out and find a decent bottom from which you can get a decent bounce out of it. So things like the index here, probably, within the next week or so, get a minor bounce, but it's going to take quite a while for this thing to all wash out. And we know that the bigger the problem, the more that the government will get involved and try and do something. Either, they'll have all their congressional meetings. The Fed is all part of all of this. Everybody's going to do what they can to, say what was wrong and what needs to be done in the future. But the issue will wash itself out, and hopefully this isn't the 1930s style that just falls apart. Hopefully it's something that they put enough cash influence into it, and it brings about some stability. So from a trading perspective, we just look for the opportunities that come along. So the banking sector, for those who are really nimble and want to take a chance, there's something there. But if you look over to some of the other sectors, as you say, like the over at the NASDAQ and some of the tech stocks, my gosh, we got Microsoft at the best level that we've seen in months here, closing off the week. Gosh, we're best since July of last year. So the money is always looking for a home.
What's going on with gold?
Gold is doing exceptionally well. There's this flight to quality that has happened. Gold for us had given a nice pullback and a basing signal for a buy back around 1800, 1810, 1820. And it had all the makings of something that just normally would have rallied back and made back 50 to 60% of its loss. And we would be targeting into the mid 1900s, 1910ish, 1920 as a target. But with the action that happened here in the banking sector, we've ended up with gold back at new highs for the year, and there's a big base here that really goes back the last 4 or 5 years. This big cup and handle pattern. Resistance is up just in the call it the just shy of $2,100 level. We're at 1980 as we close off this week. If it can manage to push through this base, which is actually all the way back to about 1100, so you measure from 1100 to 2100. You could be looking at pretty big upside potential if this thing starts to break out. But for now, it's moving on news, so it has to maintain that momentum, or you get a pretty good correction. I would suggest here that if you do see it start to wane here and maybe roll over, give back, maybe if it gives back more than $20 or $30, we'll see that the momentum's gone, and you might want to move to the sidelines for a short while. But the big pattern is still that base that we've been looking at, and we've been also looking at the miners as a good long-term hold to pick up during periods of consolidation and correction. So you don't want to chase them right now, but I think you take a look for the next time we get a decent pause, look to pick up anything from the juniors to the big names there.
Is the fall of the Canadian dollar connected to the price of crude?
It's actually, we take a look at it. Canadian dollar has not been as bad as you would expect here. We've spent the week here just under 73 cents. And that's actually just held its own this week, while crude has taken it on the nose. So I think it's an interest rate spread that's had an effect here as far as the Canadian is concerned. That's brought it down to this level in the previous couple of weeks. And if anything, it's held its own for a while. So I think that if we see the oil market bottom out, though, and, this is, to me, when we take a look at the oil, influence probably get a decent bounce in the Canadian. We've been looking at this pattern, this 10-year cycle that I looked at, and the consolidation that we've had since November in the $72 to $83 range. Pretty good resistance was in place there, and that consolidation is part of a minor, let's say, subset within the 10-year cycle. And the optimum movement here was to have broken down from 72 with a target closer to $60 to $61. And as of this week, we're starting to see the type of excesses. Well, we're down to $65 during the week here. If it pushes towards that 60 to 61, that could be a very, very good tradable low. We've got good oversold signals on the daily charts, and the monthly, if oil stays down here under $70 this month, we're going to get a pretty good buy signal on that monthly chart. So we'll be looking at probably a very good turnaround during the month of April. A tradable low, but it's going to take quite a while to form a longer-term base, but definitely look for a tradable low as we get closer to $60.
Anything else we should be keeping a close eye on?
Well, one that I don't really follow too much on, but Bitcoin had a nice breakout this week. It's best levels. There's a nice basing consolidation here that's been going on for the better part of a few months, and this has had a minor breakout a month or two ago, pulled back, and now it's got an even better and longer-term base there. As I say, for those who follow the cryptos, the Bitcoin might be worth looking at. I personally just stay away from there, but as a technician, it's intriguing to take a look at it at this point. And if anything, as I say, just for those who have an inclination over there.
Ross, thank you so much for chatting with us.
Nice to be with you, Jim.
My guest has been Ross Clark from chartsandmarkets.com. Find him on Twitter at ChartsByRoss. Coming up, John Kaiser next on This Week in Money.
Always consult your investment professional before making any investment decision. Don't miss out. Stay informed. Receive the HowStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HowStreet.com weekly recap on our homepage at HowStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is John Kaiser, publisher of Kaiser Watch on KaiserResearch.com. Welcome back to the show, John.
Jim, happy to be on This Week in Money.
John, you attended the PDAC earlier this month in Toronto. What are your thoughts, and what does PDAC stand for people who aren't familiar with it?
PDAC, or PDAC, stands for the Prospectors Developers Association Conference, and it is the big international mining show held in early March in Toronto. And we haven't had one since 2020 that was full-fledged at that time, but this was the first full-fledged PDAC, and about 24,000 people showed up as delegates. That's down from 28,000 to 30,000, but we are still, making a recovery from several years of COVID disruption. The mood was very positive on the floor. Lots of industry people were there. The PDAC now allows people with a day pass to access both the trade show and the Investors Exchange. The Investors Exchange is where all the companies have their booths, and the trade show section is where all the government pavilions and service providers have their booths. So it was nice to interact with both the government agencies and all the material they have available about the mineral potential of their country, and walk around the floor and visit the what one could of the 400 companies. The big disappointment about the PDAC is that it is now not a retail investor show at all. The Sunday newsletter writer presentation session, they had it again like they used to, full day starting at 9 o'clock going to 5 o'clock with 25-minute sessions for individual speakers or panels. The attendance was dismal, 10 to 20 people in a hall that can seat several hundred people. There used to be, 15, 20 years ago, it was packed. People came to the PDAC. Now you got to pay $25 a day, and it's clear the retail investors either aren't interested in paying $25 a day, or the resource sector is still so low on their radar that they feel no need to go there and find out what's hot and what's not.
So what are the hot areas in junior mining?
The big theme that I would walk the floor and I would talk to companies, the representatives at the booth. And so what are people that come up to your booth interested in? And they were grumbling, oh, lithium, lithium, lithium. So the idea of this 600% expansion required in lithium by 2030 to meet the electric vehicle deployment goals, this has really caught hold of the market. So a lot of companies, are investors and brokers, the fund managers and that, they're interested in lithium angles, in particular Canadian lithium angles. And the importance of lithium was evident in that Albemarle and SQM, they're big major producers which have been lithium producers for a long time. They both had a presence at PDAC, and the purpose for Albemarle is to become aware of what is the pegmatite hard rock potential. They have now partnerships in Australia with some pegmatite mines there, but they're also a big producer at the Silver Peak brine operation in Nevada. And SQM itself, obviously growing the Chilean salar brine output is not as fast as one might expect. They were also apparently walking around investigating what the pegmatite opportunities are. Copper was also very hot because the International Energy Agency has projected that we need 50% more copper than will be required by just expected macroeconomic growth by 2030 to meet the EV goals. And there hasn't been a large number of major copper deposits put into the development pipeline. So the feeling is that there's going to be a massive supply-demand imbalance coming over the next 7 years, which will put copper into a much higher price, probably in the $5 to $10 per pound range, and that's assuming inflation stabilizes. If we continue to see 6 to 8% inflation per year, then we'll probably see much higher prices. So what happened in the lithium sector, where when everybody figured out that these EVs are going to need a lot more lithium back in 2015, the Australians rose to the occasion and mobilized an awful lot of new pegmatite-sourced lithium supply. That's expanded the market dramatically. It was 130,000 tons of lithium metal. Last year, you multiply by 5 to get your lithium carbonate equivalent. But they managed to crash the price of lithium from $10, $15 a pound down below $3 a pound, where nothing really works. So between 2018 and 2020, the lithium development cycle stalled because the price was so low. But during that period, the EV rollout continued to expand, and the situation reversed. And last year, we had lithium carbonate up tenfold, was stable, spot price was stable in the $30 to $35 per pound range. It is now collapsing because obviously the Australians have mobilized new supply. The brine from this lithium triangle is now getting ramped up. So the imbalance is reversing. And last I saw, lithium carbonate prices had dropped to about $21 per pound. That has freaked out a lot of people. It wasn't bothering the people at the PDAC conference, but because they understand $10 to $15 per pound is the realistic long-term price. We need a sort of floor of $10 per pound to justify mobilizing pegmatite supply. But even if you look at $10, $15 per pound range, if you're looking at a pegmatite deposits, that's 1 to 2% 2% lithium oxide, you're still talking sort of $400 to $900 rock value. That's like the equivalent to a third of an ounce gold to a half ounce gold, open pitable with large tonnages, like 10, 20 million tons. So this lithium game is very different from gold exploration. You do not find 10 million ton deposits of half ounce gold sitting around over there to look at. So that's the buzz is there because the crisis is there. It's policy driven. The car makers have gone beyond the point of no return in deploying electric vehicles, and the need of what needs to go into these battery factories, it is now explicit. Everybody gets it. Everybody understands that the there's going to be money going into finding and developing new lithium supply. The Australians are continuing with what they started in 2015, but now it's the turn of the rest of the world. Places like countries like Canada, Scandinavia, Africa, and Brazil, obviously stable countries that have a mining culture such as Canada. This is a very sweet spot. And the governments in Quebec and Ontario, maybe the federal government is still in la land, doing virtue signaling and not really and just yapping about critical minerals. But the provincial governments, they suddenly get it, because the International Energy Agency has set the alarm. After describing what's needed, it says, we have a serious problem here, because these countries are taking 10 to 15 years to permit and develop a mine. This permitting timeline needs to be shortened so that it actually coincides with the feasibility demonstration timeline, which is typically 2 to 4 years. The permit should be in hand when you have figured out the feasibility. It shouldn't take another 3 to 5 years of being jerked around by bureaucrats after you know this material, that the project is feasible. So with lithium, we know we need this extra supply by 2030. With copper, we also know we need more supply. So lithium and copper were dominant themes at the PDAC. Gold, although gold has held up quite well, and lately post-PDAC it's perked up again. There wasn't that much enthusiasm for gold, but it's still in the background because gold is still a $200 billion a year market. Lithium's going to become $100 to $200 billion a year market, and that's what's exciting for the juniors, because it's the juniors who are going to lead the charge to figure out where all these pegmatite deposits are, delineate them, show what the grade, tonnage, and impurity ratio is, and then the big companies, they will move in and take over and put the big bucks to work to either by farming in or taking out the juniors. So that's kind of the hot area in the junior resource sector right now.
Can segments of junior mining flourish during bad economic times?
Well, the juniors already started selling off during PDAC week, and I'm sort of on record as saying, well, this year we're finally going to see the PDAC curse violated, which is that the New Year effect climaxes in early March at PDAC, and then everybody dumps their stock because they fear the adage, sell in May and go away. So they're in essence preempting a downturn. And this week, we saw the Jerome Powell, the Federal Reserve chairman, make noises about how he's going to continue to jam up interest rates because inflation is not really being subdued, and there's structural reasons for inflation being persistent. I mean, we're dealing with a massive reshoring. We're dealing with adapting to the energy transition, which is going to have at least a higher cost transitionally. So the market understands subduing inflation, you're only going to accomplish it by creating a depression. So that created a sort of a slump in the market, especially with the juniors, because they're afraid that, well, if we get a deep recession or even a depression, the demand for raw materials will go down, metal prices will go down, risk capital will not be available. And then on Thursday, the banks started to tank because the Silicon Valley Bank, which basically had taken the depositors' money and put it into very low-yielding government bonds, has felt the effects of these higher interest rates, which means the principal value of the bonds has gone down, while the depositors are kind of saying to their existing super low interest term deposits, say, well, screw this, I'm pulling my money out and buying T-bills somewhere else. So you started getting on the depositor side, pressure for higher rates, or move the money directly into these government bonds through a money market fund or something like that. And at the same time, the bank has to liquidate positions and crystallize the paper losses. If you wait long enough, these bonds will all go to maturity and pay out in full. So this then became everybody in Silicon Valley became aware of this, and some of the venture capitalists. This was really the bank for the startups, and many of them are into fintech, crypto stuff, and other bizarre things that were supposedly going to be part of the whole technology boom. And some of these were even unicorns, but these unicorns are losing their horns. They're sinking back below $1 billion valuation based on recent financing. Last year pretty much killed killed the tech bubble. And so the money these startups have in this bank was in danger of not being available if there was a run on the bank. So it became a self-fulfilling prophecy. And you had people like Peter Thiel, the great libertarian, pull out his money, or at least encourage his startups that he's been backing to pull out the money. And those who refuse to play the prisoner's game, prisoner's dilemma game, they ended up holding the bag as the run accelerated. And this has now swept everywhere. The government has said, okay, deposits will make them whole. But now people are looking at the smaller community banks, which make real loans for businesses, not just buy government bonds with the depositors' money. Now they're starting to see a run. So we've got this big problem that Jerome Powell has on his hand, that if he keeps jamming up interest rates, we're going to see further runs on banks and further problems with the government having to bail everything out. This is going to hurt the market in general. And so the obvious thing is, why do you want to be long any juniors in a backdrop like that? Even if Powell pauses the interest rate hikes to allow this storm to calm down, who's going to be interested in resource juniors? Well, there is one way that can be, because this is where this lithium story is so important, because it becomes the basis for a great Canadian area play. In the James Bay region of Quebec, it has now demonstrated to be a very lithium fertile district, probably world-class. Patriot Battery Metals right now has the 50 to 100 million ton emerging discovery that's going to run between 1% and 2%. They just raised $50 million through a charity flow-through, whose back end was purchased by Australian investors. So when you get a discovery-type play emerging against a recessionary backdrop, it's such a small space compared to the overall economy and market. And when people, once they understand the logic of it, you will see the risk capital come into these juniors. So we could have a boom within the juniors that are involved in lithium, right at the same time as everybody's singing the blues about the general economy and the big equities are flat, and Powell gets back to raising interest rates, and that, of course, makes bonds go down. So the juniors are potentially in a sweet spot in the midst of this broader hurricane. They have their own positive hurricane of a raging bull market that they are potentially entering into. So I still think that we could see the PDAC curse violated in the next quarter once the Silicon Valley Bank fuss settles down, and then people realize, well, the general economy is not going to do well for foreseeable future, but this energy transition, it's happening, whether or not we have a 1 or 2 year recession in the economy.
Is the metals and minerals supply chain broken?
The metals have been sort of a function of the globalized economy of the last couple of decades that really began with the rise of China in 2003, which created a super cycle. But what has happened is, because countries like China and Russia are autocracies, and they have an abundance, a natural abundance of raw materials in the ground, they have been able to secure a comparative advantage against other jurisdictions like Canada, the United States, Europe, where there are all kinds of environmental and health and safety rules determining, ultimately defining what the cost of production is going to be, which is going to be much higher than it will be in these jurisdictions where the autocrats tell the downstream victims, you have no say. This is an autocracy. You're taking it for the team. This is for the good of the country. So suck up the pollution or whatever. So they have had a dominant role. And I combine the percentage of global supply shared between China and Russia out of the 100%, and it's staggering. This wall of red bars of 40% to 50%, and then you look at what those similar bars look like for countries like India and the United States, and they're all below 10%, mostly below 5%. So what's happened is the supply system, the metal supply system for not so much gold. Gold is very well diversified, but for a lot of the metals, it's become concentrated in these countries like China and Russia. And with the great power competition ramping up as China goes head-to-head with the United States, and Russia trying to prove that it is still a great empire by invading Ukraine and basically allying itself with China. Now we are looking at a potential massive geopolitical supply disruption. It hasn't happened yet. The metals are still flowing around the world. But if the Ukraine situation spirals into a direct conflict between the United States and Russia, and China moves on Taiwan and finally annexes it, and all of a sudden we have this fragmented global economy, no longer a globalized economy, a deglobalized economy with these materials not so easily flowing from these autocracies into the rest of the world. This is going to be a big problem. And it's another reason I'm bullish on the resource juniors during this decade, because the major mining companies, they have two problems. One is they only want to develop really big deposits, and the second is they have an internal inertia that keeps them from doing exploration. So it's going to be really up to the juniors to go into these safer jurisdictions like Canada and Australia and even the United States, if the NIMBY crowd would ever let them, and start doing exploration and finding deposits, a whole range of them from mid-size to maybe even large size. And the majors, they'll be watching all this. When the ones that are big and in the right location and that emerge, they'll do a buyout of the junior or do a very serious farm-in deal where you're carried right through production, have no more dilution left. We're facing a situation like that where the need for new raw material supply replacing metals that aren't coming from these jurisdictions that everybody has relied on and basically benefited from dumping costs onto powerless victims of autocracy, that's all going to unwind. And the key obstacle to all this will again be the policies, the permitting policies of these Western countries. They're going to have to do some trade-offs because otherwise, if you have no raw materials, you will have massive inflation and you will have an economy that just can't grow, and you can kiss your energy transition goals, your EV goals for 2030. You can kiss them goodbye. You might as well stop talking about it now unless you act and change things. So it hasn't quite happened yet, but you can see the signs that, again, that this decade is shaping up to be a good one for the resource juniors.
What's the latest on mining in China and Russia?
When the sanctions were launched against Russia with regard to in response to the invasion of Ukraine, which is really an incredibly egregious act. Here's a sovereign country, a democracy, and this thug decides that, this really belongs to Mother Russia because I say so, and just recruits his people, conscripts, takes people out of jail, sends them there to go on a killing spree, committing war crimes, and ruining a country that was really just minding its own business while spouting garbage that bozos like Tucker Carlson pick up and end up echoing and saying that, the Putin is justified in taking on the Ukraine. They deserve this. And you have this right-wing autocracy nonsense being spouted around the world, lapped up by people in the United States. Right now we're even seeing some of the politicians like Ron DeSantis thinks that, no, we should leave Ukraine alone. And of course, some of these people, they are all wannabe autocrats. They're all thugs. They want to be able to control America and tell everybody what to do. It's totally bizarre that the more these people use the word freedom, the more they are intent on taking away the freedom of others. But what you would have thought would be a disruption of supply of metals from Russia, but everybody understood we're too dependent on it. And Russia itself shut off the gas supply, so they were using that, but they weaponized their energy supply, and sanctions were put on that, and then the pipeline was blown up by, it's pretty interesting who appears to have been responsible. Oil supplies, Europeans and North Americans aren't supposed to buy it anymore, but it goes around the circle and gets sold at a discount to China and India, who are very happy to get cheaper energy supplies. But the metals, the minerals, the potash, the nickel, the palladium, no sanctions were ever placed against it because everybody still needs these materials. And of course, the tension with China, it's still a theoretical tension, and we have all these balloon problems and stuff like that, ratcheting up the tension, but it hasn't yet turned into a serious hot conflict. So again, everything's still coming to the rest of the world, but the threat is there that as the conflict grows, and even if America decides to become an autocracy, another thug nation, well, it's not going to be Russia's pal. It's not going to be China's pal, so it'll be a three-way thug competition out there. So the United States is still going to have a problem with this raw materials when their enemies are no longer shipping it to them. So the problem is there, latent, but it hasn't yet happened.
Are junior artificial intelligence stocks going to be competition for the junior miners?
Now, Jim, that's a really good question, because part of the reason the last decade was so dismal for the resource juniors was that non-resource stories gained the upper hand. I track the TSX Venture exchange trading value, and I'm able to lift out that which is attributable to their resource listings. And for much of the past decade, the resource juniors represented 10 to 30% of the traded value. And what was trading all this value? Well, it was stories like crypto and cannabis. But both those stories have run their course. Cannabis is now a business. It's a low-margin business. The winner-take-all game has been pretty much finished. A new startup entering this really doesn't have a chance. Crypto has been discredited because it is just a BS Ponzi scheme that all these libertarian grifters have been pumping. And it's kind of really disappointing that these libertarian grifters from the West Coast there, all these venture capitalists have all been bailed out by the government. They're supposed to shun such government intervention. But at the end of the day, you find a libertarian, that libertarian is never truly true to his or her word. Anyways, the question now is, in the past year, since, in fact, December 2021, the TSX Venture Resource Juniors, they have been over 50% of the traded value and are now sort of bumping between 65 and 75%. And and the number is even higher because there's some $70 company that's from Europe that has $100 million plus in revenues that trades a bunch of value on the venture exchange, and that's not really a junior, a non-resource junior. So the money now is flowing back into the TSX resource juniors, and the non-resource stories are being shunned. So with all the fuss about AI and ChatGPT in the past 3 months, this has raised the question, is the next big thing for the resource junior or the Canadian non-resource juniors to get into AI? And I don't think it will be the case, but all these characters on the West Coast, they're already signing up, smart people who have used to work for Google or Meta or whatever, and they put together some 5-page business plan about how we're going to start to create a language model and create our own version of AI. These venture capitalists are now getting these guys and giving them money to pursue this. But this AI involves massive computing power, crunching of huge amounts of data. This is a big company story. There really isn't any way a small startup can break into this sector. So there will be attempts to float AI BS stories on the TSX Venture Exchange, but I don't think they will get the traction that the cannabis story did. The cannabis story was, and crypto was interesting because it appealed to younger generations, and one could clearly understand how regulatory changes in the case of cannabis was opening up this opportunity for cannabis businesses to emerge. But I really don't see this AI story as creating a massive business. In fact, my own concern about AI is when you put these AI programs to work, they can conceivably concoct any combination of images or sound, create any possible work that one can imagine. And if this is all available somewhere in an infinitely large cloud, really what happens to human creativity? If I actually come up with something interesting, I'm not an artist, so I can't do that, but people who do, it probably already exists out there. So the AI is going to suffer a backlash because it's going to create this, it's going to turn banal human creativity, because the AI has the capacity of being like the mind of God that is able to conceive of anything and everything possible, and it's there. And then it's going to be just about, guiding it at people. And I think the people are going to revolt at this. I think the AI is going to ultimately spawn a massive backlash by human beings saying, enough of this BS. So I don't think AI is going to end up being a problem for the resource juniors, but given the momentum mentality of the younger generations, if these things come out with well-structured and they start ramping up the price and get the BS drums going, well, I could be proven wrong that money starts flowing into something the world doesn't really need, rather than into resource juniors, which have the capacity by collective exploration coming up with those deposits which will fill the real physical needs of the future.
John, thank you so much for being on This Week in Money.
You're welcome, Jim.
My guest has been John Kaiser, publisher of Kaiser Watch on KaiserResearch.com. Coming up, Eric Hadik next on This Week in Money.
Recyclico, making lithium-ion last forever. Recyclico's patented recycling process achieves up to 100% recovery of battery metals from lithium-ion batteries for electric vehicles, including cobalt, lithium, nickel, manganese, and aluminum. Recyclico Battery Materials Incorporated trades on the TSX Venture AMY, on the OTCQB AMYZF, and Frankfurt ID4. For more information, visit recyclico.com or phone us at 778-574-4444. Recyclico, making lithium-ion last forever.
This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Eric Hadik, CEO and president of InsideTrackTrading.com. He's speaking to us from Central California. Welcome back to This Week in Money.
Well, thanks for having me back, Jim.
Eric, stock indexes seem to be really diverging, with small and mid caps getting hit the hardest while techs have been holding up. Is this consistent with cycles, and do different sectors follow different cycles?
In many respects, yes. They will often see a kind of an offset of cycles. It's not that a few sectors are going straight up while other sectors are going straight down. It's not that type of divergence. It's more a subtle thing where you get, let's just look at the intermediate turning points of the last year. You had a fairly significant bottom in mid-June. And at the time, there were a couple indexes that set pretty much their lowest low then. And so then it rallied, and you had another sell-off into late September, early October. A lot of indexes set lower lows at that time, so their downtrends were still intact, whereas a couple of key stocks and key indexes just kind of set a double bottom. Those were showing a bottoming phase. Then you saw a strong rally up into early December, another sell-off into late December. At that point, a lot of the indexes set higher lows, so it showed that bottoming phase was turning positive. And you had one particular index, the Nasdaq-100, set its lowest daily close on December 28th. So that was a continuation, but also a culmination of its downtrend. So as that whole bottoming phase was going on through the last 6 months of last year, you had different indexes starting to slowly gain ground while others were continuing to lower lows. But when we came into this year, I was explaining why the Nasdaq-100 had fulfilled a lot of its downside. It had gone right down to key downside targets that I was publishing all last year, down around that 10,800 level, and that it was starting to develop a pretty bullish situation for January, and that it was now entering more of the lead, whereas the other indexes like Dow Industrials had already fulfilled its entire upside objective back in the fourth quarter of last year. I don't know if you recall, but we had some conversations back in September, October, where I was discussing this 12-year and 24-year election cycle that I thought was going to see the Dow surge up to 34,400, right around there, and complete a 20% surge. The Dow did that last year. It hasn't taken out those early December highs since then, so it's in a different rotation and a different cycle, whereas the NASDAQ 100 was just starting to turn bullish at the start of the year. And then when we saw the February correction right into early March, the NASDAQ 100 was holding up so much better than all of the other indexes. And it did a couple of critical things that I watch on a weekly and intra-year basis. And one of those is that when you start certain time frames, there's an opening range to that time frame. So whether it's daily, weekly, monthly, or yearly, and that opening range kind of sets the tone for the first half of the whole period, first half of the whole year, first half of the whole month. And the NASDAQ 100 turned positive in late January on the opening range that I use. And it was, when it started to sell off, the key support for that intra-year trend was right around 11,800, and I'm discussing the June NASDAQ 100 futures. But they just spiked down to that on March 13th while they were fulfilling a combination of cycles that were all showing that March 13th, 14th should be a secondary low and should give way to a pretty powerful surge in the NASDAQ 100. So that's kind of what I'm operating on right now. That 11,800 held. Looks like March 13th is going to be the low. I explained in a couple of reports right then why you could see the NASDAQ 100 surge from that 11,800 level, that we could see it easily get up to 13,200 and potentially as high as 14,000 over a fairly limited period of time. I have the cycles for a potential high I've discussed in my publication. But right now, the tech stocks, the NASDAQ 100 is the index that's really in its more bullish cycle. So even as that rallies into the next phase of cycle highs, you could see a lot of the other indexes just rebound to lower highs. So they will have already put in their top. They're already in a different cycle as far as that particular sector is concerned. But meanwhile, the NASDAQ 100 should be seeing a good surge into that top. So we definitely have a lot of that type of rotation, and that's fairly well known in the markets, but there are some very specific cycles and some technical indicators that help kind of filter that and show when certain ones are in specific facets of those cycles.
Your cycles forecast a major bottom in interest rates in mid-2020, and now you've been discussing a peak in interest rates. What factored into this cycle analysis, and what does it show for the rest of this year and for next year?
Well, one of the key things that really factored into that, and I recall even discussing it with you several years ago, was this very consistent 4-year cycle in the bonds and notes, but we'll just focus on the bonds, and which trade inversely to the interest rate. So you had a series of highs in bonds in 2012 and 2016, right in the right around July of that time frame. And there was a combination of a lot of other indicators and what was showing the culmination of a major 5-wave advance, multi-year, multi-decade advance, all kind of coming into a crescendo leading into the period right around July 2020. And that's when that 4-year cycle was projecting a major top in bonds, major low in interest rate. And at the same time, I was explaining why I thought you'd see a couple years of inflation starting to take hold. In my several Inside Track newsletters I did back in mid-2020, and also some reports that are still posted on our websites and whatnot, I was quoting how Jerome Powell was talking about, and I'm paraphrasing, but basically he was saying we needed some inflation. And because things looked so deflationary at the time. And I put in the one newsletter, be careful what you wish for, because you just might get it, and then explained why all my work was showing that we should see a 2-year surge in inflation, and that's also dovetailed with my outlook for interest rates. And the dollar played into that, even stock indexes and some key commodities, which had all given major buy signals in late March of 2020, they were all showing that there was a reflationary period just beginning to take hold in mid-2020. And all of that, when I explained that 4-year cycle, I also explained how a move that follows a cycle like that usually consumes at least half of the cycle, so 2 years, and often will consume upwards to 2/3 of it. And what that does is it allows a market to move one direction for 2/3 of the cycle and then head back to a subsequent cycle peak. And let me just stop there for a second, that the 4-year cycle in bonds also projects a future cycle peak for the middle of 2024. So in between those two cycle peaks, you look for at least a 2-year decline in bonds, 2-year rise in interest rates, but more likely something around the 2/3 proportion. And that puts you into March of this year for a fairly significant top in interest rates, low in bonds. And so that's what I've been watching at this point in time. Bonds have definitely been putting in a bottoming phase since last October. They actually had their own, a converse or inverse 4-year cycle between significant lows, and October 2022 was 4 years from the October 2018 low, and a combination of other cycles. Bonds reached some downside price targets for the first leg of a major downtrend. So bonds have been in a bottoming phase since then, and we just saw a pretty sharp sell-off in February, and I was expecting an early March low and a decent surge in bonds from there. So you've got interest rates showing signs of going into a peaking phase, and markets like bonds could have already turned. They don't necessarily turn in lockstep with when interest rates set their final peak, when that final rate hike by the Fed is. The markets usually anticipate things like that, so they're already giving you clues as to what to expect from the fundamentals. And that's one of the many things that are telling me the interest rate cycle is coming to a close. And we'll probably have some things that happen later this year and early in 2024 that start to perhaps create a little bit of worry in the economy and in some other factors, and push interest rates a bit lower into that mid-2024 when bonds should see a secondary peak.
For several years, you've talked about 2023 being a pivotal year for the U.S. dollar. Is that still the case?
Yes, the dollar is definitely fulfilling almost everything that has been expected of it to the upside, and that's not only on a 2 to 3 year basis, but now on a 10 to 15 year basis, that it has rallied since its 2008 low, and that's the actual dollar index. Although one of the key things to watch when you're seeing things like that is watching the dollar index for one thing, but then watching the dollar's relationship to things like gold, which project a completely different extremes within the dollar's value when it's being valued against something other than just other fiat currencies, which is what the dollar index really represents, a basket of currencies. And so the dollar index was expected to rally up to at least 113. It got there late last year, and there's a pretty good chance we could still work our way back up and retest those highs in 2023. And that's based on a very consistent 38 to 41 month cycle that has governed the dollar index for a couple decades. And the last peak, which is related to this, was in 2020. And prior to that, there was a peak in late 2016. And the next peak is expected in 2023, when I think that the dollar is going to set a major, major top. And we're starting to see some potential fundamentals that could corroborate that. Not only things like interest rates that we were just talking about, which are one thing that have helped support the dollar over the last year or two, but you're starting to see more and more geopolitical fundamental potentials that I think will be very worrisome for the dollar in the coming years. And two of them have just involved China and the Middle East. One was in early December when China met with Saudi Arabia and the Gulf Cooperation Council and came to some big agreements about buying Middle East oil. The only stipulation was that it would be priced in Chinese yuan. And then just last week, and I still haven't seen much coverage of it, which is kind of surprising to me, but China helped negotiate this big peace agreement, or at least cessation of hostilities between Saudi Arabia and Iran. And China is making themselves a major player, particularly in the Middle East. That agreement last week took the U.S. a little bit by surprise, took Israel by surprise, and it's just, again, it's increasing China's influence in a very critical part of the world. And there's often discussion of how, dating back to 1973, that oil and the de facto agreement after the first oil embargo, where U.S. would make its concessions, and in return, Middle East oil was getting priced in dollars. And there's been attempts to significantly change that in recent years and decades, but this could be the one that really sticks and starts to have a psychological and ultimately a tangible influence, negative influence on the dollar. But there's a lot of other factors too. I just think there's some of those bigger things that you need to kind of keep aware of and see how the trend is turning. But it's like a reversing course of an aircraft carrier. You might shift the engines in reverse, but it still takes a while for that actual ship to come to a stop and then turn and begin to head in another direction. And I think that's what we're seeing in the dollar.
Your weekly relays talked about a March 8th buy signal in gold near 1820. What triggered that, and is it still intact?
Yeah, that was more of an intermediate multi-week buy signal in gold, and it kind of played on top of the fact that gold set what could be pretty significant bottom in late 2022. But when you saw the initial peak in gold in early February, I explained why I thought it should correct down to at least 1850 and probably see a spike down to 1820. But that was as far down as it should go. And gold sold off into late February, held right around that 1820 level, saw a rebound. And then as it was dropping down into March 7th, March 8th, it gave what I call a daily trend signal. And a specific indicator that I use, it needs to go from either up or down to neutral at least twice before it can reverse in the opposite direction. So if you've got an uptrend going, it would take at least 3 days for that daily trend to turn down. And that really prevents a lot of whipsawing and a lot of knee-jerk reactions influencing the actual trend that you're perceiving. And so gold, when it came off of that late February low, it gave a signal of a reversal to the upside. It also gave what I call a weekly to-close reversal higher signal, which is a 2 to 3 week signal. And so when it was selling off into March 7th, March 8th, it neutralized that daily uptrend a couple times, but could not turn it down, combined with several other indicators. I explained them more in my publications. They don't all translate real well to a verbal discussion, but it was telling me that 1820 was key support in gold and triggered this daily trend buy signal there, and was expected to trigger a surge to at least 1900 and probably up to extreme weekly target at 1937.8. I know that's kind of specific, but right around the 1940 level. And gold is just attacking that level now, so it has fulfilled that buy signal from 1820. And now it needs to show whether it's going to trigger some additional buy signals in the coming days. But that also has strongly correlated what I'm watching, looking out over the next couple months in gold and silver. And that is that there is a pretty intriguing convergence of cycles coming into play in early May, when it looks like we could see the next important peak in gold. And the significance of that is that very often in gold and silver, and there's a couple other markets that act like this, they'll often see the majority of their move right in the final weeks leading into cycles like that. A perfect example was March of last year, March of 2022. And everything was showing a peak for late February, early March. And it was only in the final few weeks when things were really ramping up between Russia and Ukraine, gold took off and surged into, I think it was March 8th, and that was it. That was the culmination of that move for gold. It gave about 80% of its move in the final few weeks of that cycle, and then a top was in for several months, even several quarters. And this early May time frame is shaping up as something like that. So I'm going to be watching not only the markets, but just kind of keeping my radar up geopolitically and economically as we get into the middle of April and the late part of April, those final weeks of a cycle that looks like it should be prompting gold and silver higher into early May. So I think that's going to be an interesting time frame to watch for some signs of new strength in metals.
Since October, your Inside Track monthly letter has been explaining why energy stocks and the XOI index were at a major top. How is that working out, and what does that mean for oil prices?
The XOI index of oil and gas stocks was really giving a textbook example of a very precise Elliott wave setup dating back to its early 2020 bottom. And a lot of times you don't see this in the market. So when a market is tracing out something like this, I pay close attention because it gives you some key levels to calculate objectives, and so this was also coinciding with multi-year cycles in oil and gas stocks that were showing an expected peak in December 2022 or January of 2023. And what that index needed to do to fulfill that was to spike above its May 2022 peak, and that June 2022 peak. And by doing that, it would show that it was completing a fifth wave to the upside. It was fulfilling these cycles. It was reaching several extreme upside targets that had been in place for many months. And so it was that synergy of all those timing and price indicators that were showing we should see a major top in that XOI index and the related oil and gas stocks. And resistance came in right around 1950 in that index. And what I was explaining to my readers then was that should trigger a multi-month decline back to 1350. So losing about a third of its value. 1350 is where that index set a low in July of last year. And that also is, from a wave standpoint, is what they call the fourth wave of lesser degree. So it was the fourth wave on the way up. More simply stated, it was the low before the final rally. And often a market, when it does complete a pretty clear five-wave advance, it will go back to that low, and that low is also viewed as very critical, pivotal support. And so that's what I have been looking for in this oil and gas index. And it could stretch out for several months to get down to that level, but right around 1350 is where there's some key support and key downside objectives. And that kind of goes along with crude that set what was expected to be a major top in June of last year. And while crude itself appears to be closer to a bottom, it's often things like those stocks that lag the actual commodity and don't have a big move until the final part of a decline in the underlying commodity. So crude, which has been heading lower, sideways to lower since June of last year, it hasn't been until just recent months that the XOI index is finally reacting to the declining price of crude with some negative action. So you're probably likely to see crude bottom out before the XOI index. And often, because you're talking about oil and gas stocks, and it's very similar to the XAU and gold and silver stocks, that those indexes are as influenced, if not more influenced, by by action in the overall stock market, as opposed to the value of crude. So if we see stocks rally for the next few weeks, hit the key levels and cycles that I'm looking for in the NASDAQ 100, and then the equity markets turn back down, even if crude has bottomed at that time, you're likely to see something like those oil and gas stocks continue lower in sympathy with the overall stock market.
It's always intriguing to see how these cycles influence natural events. Last year, you kept saying California and the West Coast would see a substantial amount of rain this winter, even though most forecasters were saying we'd see more drought. Can you give us a little more information about how you came to this conclusion and what it means for the markets?
Well, let me answer that in reverse. As far as the markets, it definitely has an impact on certain markets, and one of the ones I have been watching has been the grain markets, that they, finished some pretty serious rallies into middle to late part of last year. And part of that was on drought. Part of it was on increased demand, even going back to 2020 and 2021 with the China purchases of soybeans. So there was a combination of demand, supply shortages, labor shortages, everything working in favor of a bull market in grains. And then over the last couple of months, both corn and soybeans have given some pretty convincing sell signals, and I think that part of that is also linked to the increased precipitation that we're getting. But when you look at what was really driving that analysis, some of that has been years in the making and years in the discussion, going back to 2015, 2016 in Inside Track newsletter, where I was explaining how you've had this very consistent 40-year cycle of drought. And it doesn't mean that there's drought throughout the whole 40 years, but it means that the ebb and flow of the drought years, the wet years, they follow a similar pattern on a 40-year cycle basis. And you can go back to the 1820s, then the 1860s. In fact, you had the Civil War drought from 1856 into the early 1860s. Then you had a combination of droughts from 1895-96 into 1901, 1902, including probably the biggest one worldwide was called the Federation drought, and that really hit Australia. But then in 1930s, from 1934 through 1941, you had the Dust Bowl and everything associated with that. And then you had, in each of those instances, in 1862, 63, 1902 to 04, 1942 to 44, you had a very significant shift in that drought cycle and a few years of very copious amounts of precipitation. And then you had same thing in the 1970s, where California had its worst drought in 76, 77, and that continued to plague it until 1981, and then during the 1982-83 rainy seasons, the winter time, since it's like a Mediterranean climate, they had the most significant rain that they've had since records began in 82 and 83. And so once again, you had that 40-year cycle showing that 2016 through 2021 would see the culmination of the drought cycle. And kind of like I was just talking about in gold and some other markets, you often see a little bit of a parabolic move going into the culmination of a cycle. So we saw just that intensifying drought, and in the case of the West Coast, a lot of wildfires resulting from that. And all of that was projecting a peak in 2021, 2022. And again, I've been discussing and documenting that for 6-7 years now, so it's not just saying it now. And then in October of last year, when most of the mainstream weather people were saying another year of drought, it's going to increase, we just don't know what to do, I published several successive newsletters where I explained why there was this just incredible synergy of all different cycles coming into play during the 2022-23 winter rainy season, and even next year, the 2023-24 rainy season. And all my work, including this 40-year cycle of drought, everything was so precisely coming together that was saying we should see a major shift in precipitation, and that the California and the West Coast and moving inland from there should see a very wet, rainy season this year. And again, you can look at anything from 80-year cycles in drought and precipitation, 40 years, even like I was saying that you go back to 1862 was the great flood of where California, Nevada, and Oregon had their greatest flood in recorded history. And 1902-04 had similar. 1942 had similar. 1982-83, the greatest rainy years. But you also had a very consistent 6-year cycle that had been playing out in recent years for California and the West Coast. And the most recent was in 2017, prior to that 2011, prior to that 2005, where you had rainy years. And they were all pointing to 2023 as being the next phase in that. And then there was an 11 to 12-year cycle that is very closely linked to the solar sunspot cycle, and there's reasons that I explained why I thought that was also having an influence on that, but I won't get into that right here. But just looking back over the last couple generations in 1941, 1952, 1963, 1974, 86, 98, and 2011 were some of the biggest wet years on the West Coast. And 2022, 2023 was the next in that cycle. So it was every one of the cycles that I've been watching where this particular topic is concerned, we're all saying that this past winter, the one that we're culminating now, and the coming winter, when I even think we could probably see an El Nino kick in, we're going to seriously reverse what the West Coast has been seeing for many years. And we're now awaiting our either 11th or 12th atmospheric river getting ready to slam the state. And I think it's a pretty safe conclusion that those cycles have landed and really timed this change with pretty close precision.
Are there other natural cycles to be aware of?
There are definitely a lot of natural cycles that I follow and discuss in my monthly newsletter. When I get down to the weekly relay and related updates, I just stay focused on the numbers and trends and trading strategies. But I discuss some of the broader cycles in the monthly newsletter. And 2023 is a time for at least 2 or 3 significant events that I've been anticipating for a few years. And I even put together a 16-page report called 2023, the Year of Disruptions, which we offer free to any new subscribers. But in there, one of the things that I was explaining was how solar storms, major solar storms, have a very cyclic nature to them. And that it's another one of those cases where you have the synergy of multiple cycles that are coming into play in 2023 and again in 2024, and convincing me that we could see a pretty significant and perhaps disruptive solar storm this year. And, a lot of times people think, oh, that's kind of something from the distant past. You hear about the Great Carrington event of the late 1850s. But you can move forward from there and on multiple bases of cycles, you can see the major storms coming at specific intervals. And one of those is a very consistent 11-year interval, which is what the sunspot cycle is averaged out to about 11.2 years from low to high, back to low of the number of sunspots each month and each year. But the major storms have also had a similar timing to that. And one of the most recent phase of that cycle was in 2012. And, of course, anyone that just looks through the history books doesn't see anything significant there. But if you dig a little bit deeper, you'll see that in 2012, the sun had one of its most violent explosions. And from what astronomers and scientists could tell, it was comparable to what the storm, the explosion probably was back in the Great Carrington event. And Earth was spared because of a 9-day either lead or lag. So the rotation of the Earth and the sun was such that had that storm occurred 9 days earlier or later, I need to check my work to remember which it was, but we would have been talking about a much different situation here on Earth as a result of that solar storm. So the sun was still creating those major storms on the same interval. That one just kind of went out into space, fortunately for us. And there are, like I said, a lot of cycles that are telling me to keep my antenna, keep my radar up this year for a serious solar storm. And I'm not trying to convey an alarmism or a Chicken Little type of extreme warning about that, but it's something to be aware of and to see how these cycles have governed or influenced or timed so many natural events. And another one that's been related to that is geophysical activity, and in particular volcanoes. And 2023, 2024 plays into that cycle. So there are a lot of natural cycles that I think you need to be aware of. Some of them may not have a direct application to the markets, but they all factor into an overarching both mass psychology, instability within the world at different times, and all those things play a role in the markets and in investor psychology.
Eric, where can people get more information on Inside Track and the weekly relay?
They can go to our website at InsideTrackTrading.com, and that inside is spelled with the extra I, so it's INSIIDE, TrackTrading.com, and get all the information that they would need there, and or contact us through the website for some samples and trials and other information that we can provide.
Eric, thank you so much for being on This Week in Money.
Thanks for having me back, Jim.
My guest has been Eric Hadik, CEO and president of InsideTrackTrading.com. He was speaking to us from Central California. And that wraps up our show for this week. We'd like to thank our guests, Ross Clark, John Kaiser, and Eric Hadik. And thank you for listening. If you have any questions for the show or our guests, you can send them to info@housestreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of House Street Media Incorporated. Executive producer is Tom Allen.